Good morning, everyone. Welcome back to this second tutorial lecture. So the topic of today is non-current asset exercises. And let's go on. Agenda of today, very easy. Exercise 1. We can read together the text of the exercise. At the beginning of year 1, the company purchased a plant at 200,000. Shipping cost amounts to 7,000, while installation and testing costs invoiced are 3,000. The useful life of the plant is estimated at 10 years, and depreciation is performed at straight line basis. Moreover, no impairment losses have been recognized over the years. So don't care about impairment losses, we are going to study them during the next week, but you have to consider that their impairment losses are similar to depreciation, so we can say it is the reduction of the value of the assets. But don't worry. At the beginning of the year 3, the company decides to substitute the plant with a new one. In particular, the 2nd of January, year 3, the company purchases a new plant at 210,000. The installation and testing cost amounts to 5,000, while the training costs for employees are 8,000, and useful life is estimated at 5 years. On the same day, the company says the plant purchased in year 1 at a selling price of 170,000. And then so the receivable is collected in 150 days and the debt paid in 120 days. So the first part of the exercise, there is a new investment made by the company, while on the second one, there is the disposal, the divestiture of the old plant that the company purchased during the first year. Questions, as always, using the previous information. First of all, you have to complete the following table that now I'm going to show you. But as always, in addition, you have to draw a balance sheet, income statement, and cash flow statement of the year 3. So you have to get used to answering these questions, because you will see them in the exam and the next exercises. Okay, let's go on. This is the table that you have to complete. It is similar to the notes of the financial statements, so starting from the second year, you have to identify the gross carrying amount at the 1st of January year 2, and then additions, divestitures, and so on. The same for the accumulated depreciation at the 1st of January year 2, and then after that for the 3rd year. Starting point. First of all, we have to identify the historical cost of the asset. So, as you know, according to IAS 16, the historical cost is equal to the general cost of the plant, of the asset, and then the attributable charges. The attributable charges are useful in order to use this asset. And so, for these investments, the company has to recognize, first of all, the general cost of 200,000 plus 7,000 and 3,000. If we say the first line, the first slide. Shipping costs are 7,000 while installation and testing costs invoiced at 3,000. In order to identify the historical cost, you have to consider also these two amounts. And then the final amount that you have to recognize in the balance sheet asset side is equal to 210,000. And then obviously, in order to hold the equation, you have to account for the outflow of cash for 210. After that, so for each asset, for each intangible and tangible assets, you have to identify the depreciation at 31st December year one. So depreciation, it is like the consumption of the assets, and then in order to compute the depreciation charge, the annual depreciation charge for the first year, you have to do 210 out of the useful life. Historical cost out of useful life, 210,000 out of 10 years is equal to 21,000. This is the first depreciation charge for the first year. For what concerns the accounts, depreciation, debit side 21,000, income statement expense, and then obviously in order to hold the equation, 21,000 as accumulated depreciation. Second year, you have to repeat this procedure because depreciation has to be performed every year. And so, again, in order to compute the annual depreciation charge, historical cost, you have to consider always the historical cost and not the carrying amount, the net carrying amount. Well, 210 out of 10 years is equal to 21,000. Now you can see again the difference between the T accounts of the income statement and the balance sheet. Income statement shows only the flows that happen from the first day of the reporting period until the last one. While, the accumulated depreciation, it is like the history of that asset, and then here you find the first depreciation charge for 21,000 and then the second one of the current year. Questions so far? Let's go on. Purchase of new plants, year 3. Okay, so first of all we have to compute the historical cost of this plant. But if we consider the text of the exercise, the price of the new plant is equal to 210,000. The installation and testing cost amounts to 5,000. While the training costs for employees are 8,000, which is the historical cost of the new plant at the third year. Any idea?
It's 210,000 plus 5,000 plus 8,000.
Okay, other answers? According to International Accounting Standard 16, in order to compute historical costs, you have to consider the general cost and then the attributable charges. But if you look at the slide for this particular case, the only attributable charges are 5,000 because according to International Accounting Standard 16, the training costs for employees, that if you look at the slide, are not necessary condition to make items capable of operating. And that's the reason why you do not have to include in the historical cost the training cost for employees. And then, where do we recognize training costs for employees? What do you think about that? We did not include training costs in the historical cost of the asset, but we have to account for. Read the first answer in the chat. Income statement, I don't know. What about you? Income statement, okay. Let's go on. The recognition of training costs for employees is always in the income statement, always. You cannot include this amount in the historical cost. Okay. Updated the account. First of all, 215 as planned balance sheet asset. This is the new investment made by the company. And then obviously in order to hold the equation the same amount as account payable, because the company is going to pay, if I well remember, after 120 days or 150 days. And then training cost 8,000, income statement expense. Always, again, in order to hold the equation, the same amount has to be recognized in the account payable. Any questions so far? Please pay attention. On the 2nd January year 3, there is the disposal of the old plant. And then, so we have to identify the potential gain or loss on the disposal. How to do that? First of all, you have to consider the date of this business transaction, the 2nd January year 3. And so, the historical cost of the plant, of the old plant, was 210,000. Historical cost plus attributable charges. And moreover, the accumulated depreciation at the 2nd January year 3 is equal to the accumulated depreciation at the 31st December year 2 that you computed before, and so it's equal to 42,000. Well, the net carrying amount will be the difference between the historical cost and the accumulated depreciation, namely 168. And let's go on. The selling price is equal to 170,000. And if I compare the selling price to the net carrying amount equal to 168, I have to account for a gain on disposal equal to the difference between 170 and 168, namely 2,000. Obviously, if the carrying amount was 168 while the selling price, if the carrying amount was 170 and the selling price 168, the loss on disposal would be 2,000, the opposite situation. Probably a little bit difficult, this journal entry. First of all, since the company sold this plant, you have to reduce the historical cost for 210 of the plant credit side. Moreover, the accumulated depreciation is strictly correlated to the plant, and that's the reason why you have to reduce the accumulated depreciation for the amount of 42,000 debit side. And then, since the company is going to collect the value of 170,000, you have to account for it as an account receivable. And then, in order to hold the equation, there is the gain on disposal for 200,000. gain and loss on disposal are always recognized in the income statement. Is it right? Updated the accounts. First of all, you have to reduce the amount of the plant balance sheet asset side for 210. You have to delete the accumulated depreciation for 42,000 balance sheet asset side, and then the accounts receivable for 170,000 and the gain on disposal for 2,000. Very easy. After 120 days, the company pays the amount of 215 for the purchasing of the previous of the new plant. So 215, the outflow of cash recognized on the credit side, and there is the reduction of the account payable for the same amount. For what concerns training costs for employees, again, the outflow of cash for 8,000 and then the reduction of the account payable. Updated the account, so here there is the outflow of cash and then the reduction of the account payable. After 150 days, the company collects the selling price of the previous business transaction, so the inflow of cash is equal to 170,000, while we have to reduce the account receivable on the credit side for the same amount. Updated the account. Inflow of cash 170 credit side, and then the reduction of the account receivable. At the end of the year 3, obviously, since the company invested money in order to acquire the new plant, we have to identify the annual depreciation charge. Again, it is equal to the historical cost out of the useful life, 215,000 out of 5 years. You get the first depreciation charge equal to 43,000. The journal entry is always the same: depreciation debit side, and then accumulated depreciation, the first depreciation charge, 43,000 credit side. Questions? Update the account, depreciation income statement, expense, and then the increase of the accumulated depreciation for the same amount. Now we have to complete the table. This table is similar to the notes of financial statements, and then first of all, the gross carrying amount obviously is equal to the historical cost of the plant, namely 210,000. For the second year, no additions, no divestitures, and then obviously the balance at the 31st December year 2 is equal to 210,000. When considering accumulated depreciation, first depreciation charge 21, depreciation 21 for the second year, and then the balance at the 31st December year 2 is equal to 42,000. And then, in order to compute the carrying and the net carrying amount at the 31st December year 2, you have to do 210 minus 42,000, which is equal to 168. This is the value of the plant that will appear at the 31st December in the balance sheet asset side. Is it clear? Okay, so now 2 minutes or 3 minutes in order to do now the second part of the table, namely for the third year. This exercise is up to you. Okay, let's go on for the third year. 2 minutes in order to do now, and then we will check it later. One minute left, and then we'll check it. Okay, now the question is for you. Which is the net carrying amount of the 31st December year 3? No idea?
168000.
Okay. Let's check it together. Exercise 3. First of all, the gross carrying amount at the 1st of January year 3 is equal to 210. Moreover, the company acquired the new plant for 250, and then there were the disposal of the old plant for 210. Well, the historical cost, the balance at 31st December year 3 is equal to 215. Moreover, the accumulated depreciation at the 1st January year 3 was 42,000, and then the new depreciation charge for the current year is 43,000. But since the company divested the plant, you have to reduce the amount of the accumulated depreciation, and then it is necessary to reduce it for 42,000. And then, so the balance of the accumulated depreciation at 31st December year 3 is equal to 43,000. Well, the difference between the balance, so the historical cost at 31st December year 3, 215, minus the accumulated depreciation at 31st December year 3, 43,000, you get the net carrying amount 172,000. Is it clear? Okay, so you have to consider, first of all, the historical cost that you get at the 31st December year 2, 210, right? The company acquired the new plant for 215. We are considering just the historical cost. But moreover, if you consider the previous, just a moment, this one. So, since the company sold the asset, we have to reduce the plant for 210. That's the reason why here you find reduction as divestiture for the amount of 210. 210 plus 215 minus 210 is equal to 215. But we are just considering the historical cost of the plant. For what concerns accumulated depreciation, so again, the starting point was 42,000, namely the accumulated depreciation at the 31st December year 2, which is equal to the accumulated depreciation at the 1st January year 3. The new depreciation charge is equal to 43,000, which is the depreciation of the new plant, so this one, the new plant 215 out of 5 years. But since the company during the 3rd year sold the plant, you reduced before the amount of the accumulated depreciation when considering again this journal entry. Accumulated depreciation, that is side 42,000. This is the reason of the reduction. And then, if you compute the final value of the balance of the 31st December year 3 is equal to 43,000. But the net carrying amount is always the difference between the historical cost and the accumulated depreciation. And when the historical cost of the 31st December year 3 is equal to 215 minus the accumulated depreciation at the same moment, 43,000, the final value is 172. Is it better? Any other question? Balance sheet, income statement, and cash flow statement. The goal of this exercise. Starting from the second year, the amount of the property, plant, equipment is equal to 168,000. Where do you get it? From here, from this table. Net carrying amount of the 31st December year 2. And then the depreciation for second year, 21,000. For the next year, again, the amount of the property, plant, and equipment is 172. Where did you get it? So here, the last row of this table, net carrying amount of the 31st December year 3 is equal to 172,000. Cost for employees, always in the income statement, is a cost 8,000. First depreciation charge of the new plant acquired by the company, 43,000. And then, if you remember, there is the gain on disposal, which is always recognized in the income statement, 2,000. When considering the cash flow statement, you have to pay attention just to the outflows. The first one is the payment of the training cost for employees. Is always related to the operating activity, namely the core business of the company, 8,000. For what concerns investing activities, there is the outflow of cash for the new investment, the new plant purchased during the third year by the company, 215. And then there is the cash collected from sale of the old plant, 170. Any questions? Yes, Valeria, you have to throw up in this way. Balance sheet, income statement, and cash flow statement. Always, you have to get used to answering these questions.
I have a question. For the year 2, we have paid the plants, so isn't it in cash flow statement?
For year 2.
Okay.
Yes, you're right. There is missing outflow in the cash flow statement for the second year because the company during the second year purchased the old plant, where you will find the outflow of cash investing activity for the payment of the old plant for 210, if I well remember. You're right. Any other question? Second exercise for today. Company A recently acquired a new machine. First of all, the reception of the new machine on the 1st May year 1, but it is ready to use on the 1st July year 1. Purchase price 2 million paid in 90 days and custom duties 60,000. Insurance cost for transportation 10, transportation cost 30, and then user training by the constructor of the equipment 20,000. Another useful information is the useful life 10 years. But please pay attention, this machine is to be resold at the end of its useful life. Its residual value is estimated at 200,000. This is useful in order to compute the value of the depreciation. And then company A uses the straight line method for depreciation. But again, please pay attention, at the beginning of the year 5, company A reassesses the useful life. Due to some changes in how the machine is used, A estimates a new residual useful life of 3 years. The estimate of the residual value remains the same. Again, prepare financial statement for year 1 to year 10. First of all, we have to start from, again, the gross carrying amount, namely the historical cost, which is equal to 2 million, plus the attributable charges. But, again, you don't have to consider the user training costs, because they are always recognized in the income statement. Well, the final amount of this plant, of this machine, I don't remember, is equal to 2.1 million. Custom duties plus insurance cost plus transportation. Again, recognition of the training cost for employees in the income statement. Updated the accounts. First of all, credit side 2.1 million as machinery, balance sheet asset side, and then in order to hold the equation, account payable for this amount, for the same amount. Training cost, always income statement, 20,000, and then in order to hold the equation, account payable for 20,000. After 90 days, there is the payment of such amounts, 2 million and 12 for a reduction of the account payable, and then the outflow of cash for the same amount. As always, at the end of the reporting period, we have to compute the depreciation, which is equal to, the depreciable amount is always equal to the difference between historical cost and residual value, namely 2.1 million minus 200,000 is equal to 1.9 million. This is the depreciable amount. When considering the annual depreciation charge, you have to compute 1.9 million out of 10 years, which is equal to 190,000. But depreciation starts when the asset is ready to use. The correct date is not the 1st May year 1, but is equal to the 1st July year 1. And that's the reason why, in order to compute the depreciation charge for the first reporting period, you have to consider just the 6 months from the 1st July to the last day of the reporting period. That's the reason why depreciation for year 1 is equal to 1.9 million out of 10 years multiplied by 6 months, 95,000. Please pay attention, depreciation starts always when the machine is ready to use. That's the reason why you have to consider the 1st July year 1. Even though the company received the plant machinery on the 1st May year 1. Questions? Updated three accounts: depreciation, credit side, income statement expense, accumulated depreciation. On the opposite side, credit side, 95,000 balance sheet, the reduction of the historical cost of the asset. First year, balance sheet, income statement and cash flow statement. Final amount, the net carrying amount of the machinery is always the difference between historical cost, the gross carrying amount, and the first depreciation charge. 2,005,000. When considering the income statement for the first year, depreciation charge is equal to 95,000. It is a cost, and then training costs for employees again in the income statement, 20,000. Cash flow statement again, outflows to the employees, 20,000 operating activity, while new investment has to be recognized in investing activity, payment for machinery, 2.1 million. Subsequent depreciation charges. First of all, since we are considering the second year, the depreciation charge starts from the 1st January year 2 until the last day of the reporting period. And then, so depreciation for the second year will be historical cost again out of 10 years, the useful life, 190,000. And it is the same for the third and the fourth year. Update the accounts. Again, depreciation, income statement expense, debit side 190, and then accumulated depreciation, same amount on the opposite side in order to hold the equation. Again, here you can see the difference between depreciation, income statement, and accumulated depreciation balance sheet. Just the accrued charge in the income statement, while here you find the history of the plant. First depreciation charge for the first year, and then the current depreciation charge. Year 3, again, you have to increase the amount of the accumulated depreciation, but here, as depreciation income statement, you will find just the first charge, 190. Again, the next year, here there is the increase of the accumulated depreciation for 190. And then the recognition of the income statement, of the depreciation in the income statement. Balance sheet, income statement, and cash flow statement for the second, the third, and the fourth year. So the amount of the machine for the first year we saw before is approximately 2 million, while the depreciation is 95,000 starting from the 1st July of the year 1 until the last day of the reporting period. Moreover, for the second year, the amount of the machine, the net carrying amount of the machine is approximately 1.8 million, while the depreciation charge is equal to 190,000. And so on for the third and the fourth year. Please pay attention. There are no inflows or outflows for the second, the third, and the fourth year. Depreciation doesn't affect the cash flow statement, never. Any questions? On the 1st of January year 5, please pay attention, there is the useful life reassessment. The company has to consider the new residual life equal to 3 years. The previous one was 5 years, the residual useful life. So, the new depreciation charge is computed as follows. As always, the depreciable amount is equal to the difference between the carrying amount, for this case, at the 31st December year 4, and then the residual value. Namely, the value that you can get here at the 31st December year 4, balance sheet approximately 1.54 million, minus the same residual value 200,000. And then, so the new depreciation charge will be the difference between the depreciable amount out of the new residual useful life, 3 years, the value of the depreciation for the current year is this variable number. Is it clear? Okay, updated the accounts at the 31st December year 5. Here there is the new depreciation charge, again income statement expense, and then in order to hold the equation, you have to increase the value of the accumulated depreciation for the same amount. The same is for next year. Again, just the depreciation charge of the exercise 6, and then so the accumulated depreciation again increase for the same amount. Next year again, as always, depreciation is affected by the depreciation of the charge of the current year, and then again the accumulated depreciation is affected by the same amount. Balance sheet income statement for year 5, year 6, and year 7. So please pay attention. You will find at the end of the last reporting period, so according to the useful life of the machinery, will be equal to the residual value 200,000. And then again depreciation, net carrying amount in the balance sheet, and so no flows or inflows for year 5, year 6, and year 7. Any questions so far? Exercise 3 from the exam of January 2021. On 1st March year 1, company A purchased a new plant, considering the following information. General cost, base cost 20,000, shipping cost 1.5 thousand, testing cost 2.5 thousand, installation cost 1,000, again training cost for employees 3,000. But please consider that the plant is ready to use on the 1st July year 1. But moreover, in order to draw a financial statement, you have to consider also dismantling costs that will occur at the end of the useful life of 15 years. The nominal value is 7,000, while the interest rate is 3%. What will be the question? present double entry records for year 1 and year 2, and then draw a financial statement. First step, we have to identify the historical cost that has to be recognized in the balance sheet. Again, base cost 20,000, shipping cost 1.5 thousand, testing cost another attributable charge 2.5 thousand, installation cost again 1,000, and then obviously you don't have to consider training costs for employees 3,000. But moreover, we need to identify, to compute the present value of dismantling cost. How to do that? How to identify the present value of dismantling cost. Present value is equal to the nominal value of dismantling cost multiplied by 1 plus interest rate to the power of 15 of t. And when the final value, the present value of these dismantling costs is equal to 4,493. Do you agree? And let's go. The final value of the asset will be 29,493, which is the initial amount of the plant at the 1st July year 1, when the company has to recognize this value. But please pay attention now. The first double entry record is this one. On the debit side, there is 25,000 for plant, and then in order to hold the equation, 25 as outflow of cash. Which is the reason of that? First of all, you have to consider just the effective outflows for 25,000, because the present value of the dismantling cost will be paid probably at the end of the useful life, namely after 15 years. But I've just said the value of the plant was approximately 29,000, and so we have to consider also. So these are the updated T accounts: plant, balance sheet 25,000, and the outflow of cash for 25,000. But in order to achieve the value of approximately 29,000, we have to increase the value of the plant through these journal entry record. Debit side is the increase of the plant for the present value of the dismantling cost, and then in order to hold the equation, you have to recognize the provision for the same amount, balance sheet liability side. updated the accounts. If you look at the slide, the final value of the plant is equal to the historical cost that we computed before, 29,000, while the provision for this monthly cost is equal to 4,000. Journal entries at the end of the reporting period. Again, you have to compute the depreciation charge, which is equal to historical cost of 29,000 out of useful life of 15 years. The annual depreciation charge is equal to 1.9. But again, depreciation starts when the plant is ready to use, namely the 1st July 2021. And that's the reason why the depreciation charge for the first year will be the half of the previous value, 983. Depreciation, debit side, such amount, and then in order to hold the equation, accumulated depreciation for the same value. Updated T accounts. Depreciation, income statement, cost, and accumulated depreciation, balance sheet, the reduction of the historical cost of the assets. Now you haven't studied it yet, but at the end of the reporting period we have to bring the value of the provision of dismantling costs as we computed the present value at the 14th year. That's the reason why, according to IFRS 9, probably the toughest standard of international accounting standards, international financial reporting standard, what you're gonna study very briefly during the last lecture of this course, we have to consider the interest expense related to dismantling costs in order to bring the value of the provision at the 31st December year 1, because we computed before the value of the provision, so the present value. But I remind you, the nominal value after 15 years should be 7,000. In order to do so, first of all, you have to consider the provision of the 1st July year 1, which is equal to the present value that we computed before. The interest rate is equal to 3%. And then again, this is similar to the depreciation that we computed before. First of all, we have to identify the annual depreciation expense, which is equal to the present value of the provision multiplied by the interest rate. But the first interest charge is equal to the half of the previous value, and namely 76. This is the only way in order to get, after 15 years, the amount of the provision equal to 7,000, because for the first year you computed the present value of this amount. Is it clear? Now let's go on, probably after that will be easier. Journal entries at the end of the reporting period. So this interest expense is just a figurative interest expense because the company does not pay this amount. 67 will appear just in the income statement. And then, in order to increase the value of the provision, we have to account for 67 on the credit side. Interest expense and interest expense according to IFRS 9, and then provision for dismantling costs 67. Updated the account. Again, interest expense, income statement costs, and then increase of the provision for dismantling costs for 67 balance sheet liability side. Balance sheet, income statement, and cash flow statement for the first year. First of all, the amount of the plant will be the historical cost minus the first half depreciation charge. As always, 28,000. And moreover, the provision for dismantling costs will be the present value plus the first charge computed before, according to IFRS 9. The final value of the provision at the 31st December year 1 is equal to the present value computed at the power of 14. And moreover, income statement will be affected by depreciation, first depreciation charge, and then the interest expense computed before. For what concerns the investing activities, here there is just the effective outflow that we computed before, 25,000.
Sorry, there is a training cost.
Probably you're right. It's later. So let's go on. Journal entries at the end of the second year. Again, depreciation charge. This is an annual depreciation charge equal to 1,900 and so on. Depreciation debit side, income statement costs, and then again, in order to solve the equation, accumulated depreciation for the same amount, credit side. Updated the account, depreciation, income statement cost, and then accumulated depreciation, balance sheet, the reduction of the value of the assets. Again, every year you have to compute the figurative interest expense according to IFRS 9 in order to bring the value of the dismantling cost towards the last year of the useful life. But first of all, please pay attention. The starting point in order to compute the annual interest expense is the provision at the 31st December year 1 before we consider the provision at the 1st July year 1. Now you have to consider the last value of the provision that you can get from the previous balance sheet, the balance sheet of the first year. Again, the interest rate is 3%. And then in order to get the annual interest expense, we have to do these operations. So the provision at the 31st December year 1 multiplied by the interest rate is equal to, again, the interest expense for 137.36. Journal entry, interest expense, debit side 136, and then provision for dismantling costs as we did before, 136. Great site. Update the accounts, again, interest expense, income statement, cost, and then provision for dismantling cost, 136. Balance sheet for the second year, income statement and cash flow statement. Again, the plant is equal to the difference between historical cost minus the first depreciation charge and the current depreciation charge, which is the net carrying amount is equal to 26,000. And then the amount of the provision at the 31st December year 2 is a little bit higher than the provision for dismantling costs at the 31st December year 1 due to these adjustments according to IFRS 9. For 1,500, this part of the provision is equal to the provision at the 31st December year 1 plus the interest expense of the current year. Moreover, again, in the income statement, you will find depreciation for the annual depreciation charge equal to 1,900, and then the interest expense. But for the second year, there are no outflows or inflows. Is it clear? Because now I have a question for you. 10 minutes in order to compute the value of the provision for dismantling cost for the year 3 and year 4, and then the interest expense. And then we will check it together. You have to compute now the amount of the provision for dismantling costs for the 3rd and the 4th year, and the same for the interest expense. Good luck. I'm going to give you a tip. The starting point is this amount of the provision. You can see this answer.
This is interest expense because the first year we calculate only the half of the year, and you said that at the end of the year it will be 7,000 whole.
Insurance expense? Insurance?
No, interest.
Interest expense, okay.
Yeah, so
Because the starting point was the first of July,
Yeah.
the year one, and then
Yeah.
you have to consider just 6 months.
I know, like, this is what I'm like thinking because like at the end of the year 15 it will be 7,000, but we just calculate the
Yes,
first year the
yes,
half.
you're right.
But can it be 7,000 at the end?
At the end, yes.
Yeah.
But we'll check it later.
Okay.
Don't worry.
So you need to calculate the provision the year spent.
Five minutes left.
Because after 15th year, there will be under 6 months. Now it's
1 minute left. Okay, let's check it together, the value of the provision at the third and fourth year, and then the interest expense. Okay, this is a tough table, but don't worry. Why do we need to apply the amortized cost IFRS 9 to dismantling cost? This procedure is called the amortized cost that you're gonna study during the last lecture of this course. But don't worry. First of all, year one, just half year. This is the present value that we computed at the beginning of the exercise. And then the interest expense just for 6 months for the first year. The value of the provision at the beginning of the reporting period plus the interest expense, you get the value of the provision at the end of the reporting period. Obviously, the value of the provision at the end of the year 1 is equal to the value of the provision at the beginning of the year 2. 4,560, and then again, if you compute the 3% to this value, to the value of the provision at the beginning of the reporting period, you get the interest expense. But again, 4,560 plus 136, you get the value of the provision at the 31st December of the second year. If you go on step by step for each year, you get the value of the provision at the end of the third year, which is equal to 4,838, while the interest expense is equal to 140. And let's go for the next year. So the value of the provision at the end of the reporting period is equal to 4,900, and so on, while the interest expense is approximately 145. Is it clear? I hope so.
Yes.
If you let's go on for 15 years, but please pay attention, since the first year it was composed just of 6 months because the machinery was ready to use on the 1st July. So the last year you have to consider just 6 months, and then you have to compute again the interest expense just for 6 months. Through this procedure you get the final value after 15 years of 7,000, which is the value of the provision at the end of the useful life of the asset. I did it on Excel, don't worry. Any questions? Exercise 4, again from the exam of January 2021. This could be useful in order to do your group assignment. Below you can find an excerpt from Campari 2019 consolidated financial statement. And if you look at the slide, the first column is land and buildings, and then plant and machinery, other 1,000, and so on, and finally the final amount, total 1,000. There is the amount at the 31st December 2018, and then the amount at the 31st December 2019. Questions of the exercise. How much are net tangible fixed assets recognized in 2019 consolidated financial statements? How did you compute it? And how much is the depreciation recognized in 2019 income statement? Again, now I write these questions in the chat and then take 5-10 minutes in order to identify them. You have to look at this slide and the questions are in the chat. I'm waiting for your answer in the chat.
Did you find them? Can we check it?
Yeah.
Okay, let's go on. First question, how much are net tangible fixed assets recognized in 2019 consolidated financial statements? So the value, the correct value is that 94,260. Is it clear? You have to consider just the total, the last column, not the excerpt. How did you compute it? So there are two options in order to get this value. You can start from the beginning of the table. Okay, so carrying amount minus the accumulated depreciation at the 31st December 2019, or otherwise from the bottom of this these except so carrying amount at the end of the period minus the accumulated depreciation at the end of the period. Or moreover, the other option is 95 at the value of the 31st December 2018 plus the new investments minus the disposal minus the depreciation for the current year and minus the impairment losses. These are two different options in order to reach the goal. And then, how much is depreciation recognized in 2019 income statement? The value is 8,237. I've prepared another additional exercise for you.
Excuse me, Professor. I have a question on the previous.
Okay? Then we talk about at the end of the lecture.
Yeah.
Another extra exercise for you. Very, very easy. It's really easy. Prepare the current assets and current liabilities section of the statements of financial position as of 31st December year 1 using the minimum line items permitted under IAS 1. We can read together. The general ledger trial balance at the 31st December year 1 includes the following asset and liability account: interest payable, trade receivables, account payable, prepayment to suppliers, inventory of finished goods, allowance for doubtful debts, and so on. And please consider that the loan is due at the 31st October year 2, while the lease includes an amount of 13,000 for lease payment due before 31st December year 2. The company classifies assets and liabilities using a current and non-current basis. And so you have to prepare the current assets and current liabilities section of the statements of financial position at the 31st December year 1. So this is another exercise for you. You have to do it now, and then we are gonna check it after 10 minutes, 5 or 10 minutes. You have to prepare the current assets and current liabilities section of the financial statements according to this information.
Can we check it? It should be easy, this exercise.
Solution of the exercise. I will upload it on Moodle, don't worry. First of all, current asset, always cash and cash equivalents for 10. Moreover, the difference between the value of trade receivable minus the allowance that you see here, allowance for doubtful debt. It seems like the accumulated depreciation and historical cost of the value. The trade receivables are 100 and the allowance for doubtful debt are equal to 8. The difference is equal to 92,000. Moreover, the warehouse is composed of 120 plus 60, which is equal to 180. While other non-current assets, 12 for the prepayments to suppliers, 12. On the opposite side, current liabilities, you have to consider 2,000 for interest payable, 85,000 for the accounts payable, and then each 20,000 for accrued wages and salaries. Financial liabilities, there is 100 as the loan, and then the first charge of the lease contract for 13,000. All of them are financial liabilities. And then the last item is the current tax liability for 30. This was the solution. Okay, so for today, the lecture is over. Thank you for your attention and see you the next week.
Thank you.
Allora,
And then we have information from the tables of taking payment of all the taxes payables, which relates to government and operating activity. That's the thing from customers